If you missed the financial news recently, let me summarize everything that has happened in the past few weeks to find out if the market will keep crashing or it will finally recover. Back at the end of February, when it seemed like the market won't crash further, it kept falling. And right now, everyone is confused about whether they should buy or wait till it keeps dropping more and more. Personally, I would love for it to keep falling, but it seems like it won't because the Fed got out on 17th of March and clarified everything. We'll talk about what the Fed said, what does that mean, and how is it going to impact the stock market. One of the metrics that investors use to value companies is discounted cash flow. It can help us to understand where the market is overall headed to. Without getting into a lot of details, I will explain what discounted cash flow is, how is that related to what the Fed said, and will there be another crash? Interest rates aren't just important because they make borrowing money cheap or expensive today, but also because they influence the value of future cash flow, which is what investors are concerned about the most. You don't care about how much the company is earning today or how much it has been earning in the past. What matters at the end of the day is how much the company is going to earn in the future. Based on that, you will decide whether you should invest in this company or not. Stocks always compete with other types of investments such as bonds, cash, fixed deposits, whatever. Let's say you have $1,000 in your pocket. Is it better to invest in the stock market, bond market, or just keep it in your wallet? Obviously, investing is way better. Let's say interest rates are just 5%. If you invest in government bonds, your $1,000 will worth $1,005 next year. So it's important to look at the time value of money. The sooner you have the cash on your hands, the more it's worth, because the sooner you will be able to invest it. $1 today is worth more than $1 tomorrow. So if the company is going to earn $1 billion 5 years from now, it is not going to be $1 billion, because $1 billion 5 years from now worth less than $1 billion worth today, because you could invest it and get 5% at least every year. So it's not enough to look at the company's future cash flow. Oh, this is how much the company is going to earn in the next 3, 5, or 10 years. But you have to find the present value of future cash flow. How much that $1 billion 5 years from now worth today? It sounds a bit complicated, but I'll try my best to simplify everything. You can use this metric in the future to value other companies. Of course, no one knows how much any company would earn in the future. It's all predictions. But these predictions are based on multiple factors such as how the company is performing today, where is it investing, what is their strategy, how is the business environment, what are the chances that the company will hit its annual objectives, what is the political climate. There are a lot of analysts who prepare certain type of predictions. Let's say hypothetically there is a company called Amazon and it's expected that it will generate $100,000 every year for the next 3 years. On the other side, interest rates are just 5%. They're expected to stay there for the next 3 years. At that rate, $100,000 next year would worth $95,238. I got that number by dividing the future cash flow, which is $100,000, by 1 plus 0.05% at the power of 1, because the formula is future cash flow divided 1 plus R, which is the rate, at the power of the year. If we apply the same formula in the second and third year, these are the numbers we're going to get. First year, $95,238, second year, $90,702, third year, $86,383. The company's future cash flow isn't $300,000 as it seems at first glance, but $272,323, or the sum of these three numbers. I told you, it's not as complicated as it seems. Here's the interesting part. What happens if interest rates are lower? What happens if the Fed lowers interest rates to 1%, for example? How will that impact the projected cash flow? Let's do the math. First year, instead of $95,238, it is going to be $99,009. When the Fed lowers interest rates, suddenly on paper, these companies are going to make more money, even though nothing absolutely changed for them. Let's do the second year and the third. The second year will be $98,029 and the third $97,059, which makes it a total sum of $294,097, which is higher than the previous $272,000. Remember, the most important thing that investors care about is how much the company is going to earn in the future. That's why whenever the Fed lowers interest rates, stocks become much more attractive, even if they're not going to borrow money. This metric is even more important when it comes to tech stocks, because most tech companies are betting on making huge profits in the future, such as Tesla. It's a great company, but it's barely profitable. But the idea behind it is that sometime in the future, it is going to be super profitable. It is going to make a lot of money. But $1 today worth more than $1 tomorrow. So when the Fed lowers interest rates, tech stocks suddenly jump through the roof. So since the end of February, when the stock market started falling, everyone thought it's just a one-day thing. Honestly, I jumped in and bought some shares. I wasn't expecting that it could get worse. I mean, theoretically, it could, but if it doesn't, I will miss the opportunity. But the market kept falling and falling. Of course, I bought more stocks, and on the 17th of March, the Federal Reserve said, "Listen guys, we understand that the economy hasn't recovered yet. Some businesses of course are doing better than they did last year, but we feel like in the next few years we will keep interest rates low." What do you think low interest rates mean? 0 to 0.25% at best. You can't get lower than that unless you go negative, which already happened in some countries. Anyways, it's a clear message from the Fed that this year we will keep the rates low, which means the market will most probably keep rising. Of course, that's gonna cause inflation, but the Fed said, "We know that, but that's not a problem now." Imagine what message does that send to investors. Don't hold cash, because it is going to worth a lot less. This means there will be more money thrown into the stock market, which means stocks will keep rising. So, based on the current circumstances, it's difficult to believe that there is going to be some kind of a major crash in the coming future, at least till the end of the year. Another correction? Maybe. I don't know, but corrections happen time to time, so I wouldn't be surprised to see a few of them throughout the year, especially if you're dollar cost averaging. These dips are the perfect time to buy. If the market is heading higher and higher, buying when there is a dip is a perfect option. By the way, I am not a financial advisor, and everything I say in this video is for educational and entertainment purposes, and nothing more. So, do not base your financial decision on what a random people say on YouTube. Low interest rates also means that these companies will keep borrowing money. When interest rates are almost at 0%, any money you borrow is free. Even if you do not need that money, you will still turn a profit if you borrow it and invest it elsewhere. It makes sense to borrow as much money as possible at 0.25%, for example. So, any return you make above 0.25% is considered to be a profit. So, when the Fed is planning to keep the rates at such a low rate until 2023, it's extremely difficult to imagine that there could be a crash or anything like that. Of course, we don't know for sure whether interest rates will stay that low for another 2 years. Anything could change, only time will tell. What really worries me is higher bond rates. Bonds have an inverse relationship with the market because bonds are much safer than the stock market. With stocks, the company could go bankrupt or perform poorly, but with government bonds, chances that the government will collapse are really low. So whenever bond rates rise, a lot of investors choose bonds over the stocks. So the stock market slows down. But we'll talk about that in another video. For now, I really want to know your opinion about this new format. Regular videos on the channel aren't going to stop, but we want to try something new where I can update you about the financial news, about what's happening in the market, and try to help you read between the lines. But to be able to make videos a bit quicker, we have to make them simpler. So I'm curious to know your opinion. Let me know that by giving this video a thumbs up and commenting down below. Thanks for watching, and until next time.